What is monetary policy? So monetary policy is really, it's the Fed's decisions regarding the money supply. Do you remember when we were learning about money, we drew monetary policy, we drew the money supply as a vertical line starting, which represented the fact that Fed controls the money policy, the money supply. And as a result, the supply of money is whatever the Fed wants it to be. And so what we're going to think about today is, all right, well, how does the Fed decide what it wants the money supply to be? And how does the Fed actually go about adjusting the money supply? So those are the two main things we're going to think about today. And there was stuff about real and nominal interest rates. I'll get to that at some point. Not today. It's only a couple of minutes. I may just throw it up on a short video. All right. So we're going to learn about how monetary policy works. I call it putting it all together. So one of the things that I said, starting with really when we started learning about aggregate expenditures and aggregate demand, aggregate supply, I said that, some of this is going to seem a little bit disjointed, but if you just trust me, eventually we're going to put it all together. Well, today is the day that we put it all together. And so we're going to put all these things we've talked about, all these graphs we've drawn, we're going to combine them today. So this really goes all the way back to when we first started after the first midterm learning what macroeconomics is. So we said that GDP has a general upward trend. So the last couple hundred years we have seen growth. But there's also lots of fluctuation around this trend. So there's some noise there in the sense that we'll have big increases in GDP, then we'll have decreases in GDP. And monetary policy seeks to minimize these fluctuations of GDP. So the Fed is out there trying to keep the economy on this sort of steady path upward. And what we're going to learn today is the Fed is able to do this because changes in the money supply affect GDP. And so what we're going to learn about first is how do changes in the money supply affect GDP. So we're going to go through these steps here. So we're going to think about how the money supply affects interest rates, how interest rates affect investment, how investment affects aggregate demand, and how aggregate demand affects real GDP. And don't worry, we are going to work through each one of these steps. So each one of these, we're going to look at each of them individually. And I think all of them should individually make sense. So hopefully the whole way that everything flows through makes sense. All right. Oh, and I like it. We have good animations. So we'll start off with the relationship between money supply and interest rates. Whoosh. What happens to interest rates when the money supply decreases? Why is this? Well, we're going to look at, this is coming from the money slide deck. So we said a decrease in the money supply could cause a shortage of money. So thinking about back to the Marios and the Luigis, when we have lots of people wanting to get something, then what we're going to see is there would be a shortage. We have lots of people wanting to get it, not many wanting it, not many wanting to sell it. So these people who are left out, some of them will offer more money. Well, in the terms of money, what that means is that if there's a lot of people who want money, they bid the price, which is the interest rate, up so that the market clears. So again, when money is sort of hard to come by and there's not much money out there, you're going to have to pay a lot. You're going to have to pay a lot in interest if you want money right now. No money supply decreases. This shifts to the left, so we get movement along the money demand curve, and as a result, the interest rate increases. So next thing we're going to look at, so we just determined how money supply affects interest rates. Now let's look at the relationship between interest rates and investment. So what happens to investment when interest rates increase? So why is it that when interest rates increase, investment decreases? So from the aggregate expenditure slide deck, we learned that firms will invest when the expected rate of return is greater than the real interest rate. And the reason for this, you think about from a cost-benefit perspective. So expected rate of return, that's the benefit you get from investing. The real interest rate is the cost of investing. So because, remember we talked about this with Michael Scott, where when he's deciding to buy a forklift, if you already have the money, what you're doing is you're thinking about you are foregoing the real interest rates. You want to make sure you earn more from your investment than you would earn in the bank. Or if you have to borrow money, then you want to make sure that you're making more from the investment they're going to be paying in interest. Okay. Next, look at this. We looked at this before. So we had deciding whether or not to buy a forklift. The interest rate is 3%. So this right here is the marginal benefit of buying additional forklifts. As we would expect, we have decreasing marginal benefits. So first forklift gives you a lot of benefit. By the time we get to the third, there's just not that much for you to do with it. It's really not adding a lot. Let's compare that with the marginal opportunity cost. So opportunity cost is how much it's going to cost you in interest. Well, if you're borrowing $100, interest rate's 3%, your marginal opportunity cost is $3. And for the first two forklifts, our marginal benefit of $5 and $4 exceeds our marginal opportunity cost. For the last forklift, the marginal benefit is only $2 and the marginal cost is $3, so we are not going to buy that third forklift. So if interest rate is 3%, we are going to purchase two forklifts. Okay. What if the interest rate went down? So what if the interest rate goes down to 1%? Well, then we can look at that third forklift. And it's still, everything is the same on this side. The only thing that changed is the opportunity cost of borrowing money. And the marginal benefit remains $2. But now the marginal opportunity cost has gone from $3 down to $1. So now the benefit exceeds the cost. So we are going to buy that third forklift. So notice that when interest rate went from 3% down to 1%, our investment went from 2 forklifts up to 3. This means that we have a negative or inverse relationship, downward sloping, between interest rate and the quantity of investment. So when we have high interest rates, we have less investing. When interest rates go down, investment goes up. Next, let's look at the relationship between investment and aggregate demand. So which of those three statements is true? From the aggregate demand and aggregate supply slide deck, we learned that aggregate demand is equal to all the ways we can spend money. So same as the expenditures formula for GDP. It's equal to consumption plus investment plus government spending plus net exports. Well, investment is a component, and so when we buy that third forklift, that leads to an increase in aggregate demand. All right, next, looking for the relationship between aggregate demand and real GDP. This is our last step. So I kind of did the easy part, which was that telling you that we know that when aggregate demand increases, real GDP increases, right? So when Michael buys that extra forklift, somebody's making that extra forklift, so that's going to increase GDP. All right. What happens at price level when aggregate demand increases? The answer here is A. Is it? Yes. It increases. How do we know this? Well, if we go back to the aggregate demand and aggregate supply slide deck, we learned about how aggregate demand slopes down, aggregate demand supply slopes up. This works out really well because it looks just like the product supply and demand curves we learned about. Where they intersect, we get equilibrium GDP and equilibrium price level. So when we get an increase in aggregate demand, so Michael goes out and buys this forklift, well, what happens? Our equilibrium changes up here. Price level increases and GDP increases. So what this means is that if we go back here, we start off with money supply. We worked all the way through to see the effect on real GDP. Well, by adjusting the money supply, the Fed can influence both real GDP and inflation, right? Notice here, GDP increased and inflation increased. The answer for the last top hat question was A, it increases. So the relationship between GDP and inflation, by this model, if we're moving around aggregate demand, we do expect to see an increases in inflation. In the real world, we do sometimes see increases in GDP without inflation, and we can think about that maybe what's going on is sometimes aggregate supply can be moving, and so that would have that could cause an increase in GDP without causing inflation, for example. All right. Now we're going to learn about these terms, expansionary and contractionary monetary policy. So expansionary monetary policy seeks to help the economy grow by boosting GDP. So I think there's blanks in this. I probably just draw an arrow up or down for all of them. So expansionary monetary policy, we're going to expand the money supply. We're going to increase the money supply. That'll work to reduce interest rates, which will increase investment. I'm trying here. Increase aggregate demand, get a little better, and increase real GDP. Oh, that one worked out okay. I'm figuring this out. Remember, I'm just staring at a green piece of fabric here. So that is expansionary monetary policy. Cold here right now. That's our weather. Contractionary monetary policy seeks to slow the growth of GDP and reduce inflation. How does that work? Well, let's go the opposite direction. It will decrease the money supply, increase the interest rates, decrease investment, decrease aggregate demand, and decrease real GDP. So contractionary monetary policy, so the amount of money is contracting or decreasing, and that leads to a decrease in real GDP. So why would we ever want GDP to go down? I remember, I think Graham was talked a little about this, that if you get an increase in GDP during an expansion, that's generally not a sustainable increase. So if we wind up above our long run aggregate supply, essentially what's going on here, again, people work a lot of overtime that they're not going to want to keep working. Businesses are running their factories beyond capacity. They're foregoing making investments because they're having to run everything all the time. So that is sort of why you would want to slow the growth of GDP. So next thing we're going to think about is how the Fed does monetary policy. And what I mean there is the Fed, we know that they're expanding and contracting money supply. What we want to think about is, all right, how are they doing that? How are they making the money supply larger or smaller? We can think of there being two ways that the Fed adjusts the money supply. We can adjust bank reserves, or we can adjust the money multiplier. So our change, what's the change in money supply? It's going to be equal to the money multiplier times the change in reserve. Remember, reserves is the money that is getting put in the bank by someone. That's the money deposited. So how does the Fed do this? Well, again, they're going to do one of these two things, and we're going to look first at their way of adjusting bank reserves. They do this through what are known as open market operations. So what are open market operations? That is the Fed's practice of buying and selling U.S. Treasury bonds to influence the money supply. Open market operations are the Fed's main tool for adjusting the money supply. Okay. This is likely quite confusing. We don't really know how buying and selling bonds has anything to do with the money supply. So let's go ahead and learn. So buying bonds, known as monetary expansion. Let's see how this works. So step one, the Fed is going to use money to purchase Treasury bonds. So again, the Fed gives the bank money. In exchange, the bank gives the Fed Treasury bonds, which are interest which are issued by the Fed. Okay, bank now has extra money. They can take this money. Because there's an increase in their bank reserves, they're going to be able to take that money and loan it out. So again, bank gets money, they're able to loan it out because they had this increase in money there. Remember, in order for the banks to be able to loan money to Michael, it needs to be the case that they have money to loan out. They need to have extra money come into their vault. Once they do, they can loan it out. Oh, hi, doggy. Now, the money multiplier serves to take this initial increase in money and multiply it out to make an even larger change. And how does this work? Well, this is Michael borrowing for the forklift. And so Michael takes the money and buys the forklift. And then the person who buys the forklift company owner takes that money, puts it in the bank. Then once that's done, the bank keeps a little of it on hand, loans the rest of it out to someone who wants to expand their restaurant. Restaurant supply operator takes that money they've earned, they put it in the bank. And someone else wants to borrow money. Well, the bank holds a little more in reserve, loans the rest out. And so this is how the money multiplier works. It works because the banks only have to keep a little bit of money on hand and are able to loan out the rest. Okay, we can now look at selling bonds and how that works to create monetary contraction or contractionary monetary policy. So this works in the opposite way from monetary expansion. The Fed sells bonds instead of buying them. What does that look like? Well, we have U.S. Treasury bonds going from the Fed to the bank. The bank then sends money to the Fed. So this is now taking money out of circulation. The bank now has U.S. Treasury bonds, and they've lost some money out of their reserves. So the Fed collects money from people and financial institutions, and in return gives them bonds from the Fed, removing those funds from circulation. So someone asked me to go over what a Treasury bond is. So it's going to be bonds that the Fed issues. And remember, bonds, the way they work is I give you money now, you give me a little bit more money than that in the future. That's really all we need to know for the purposes of this class, is that something other than cash that the banks have, they earn some money, they earn some interest on it, which is why they're willing to buy them. And the Fed can issue them, and they'll do it so that they can get money out of the banking system. Removing money from deposits to purchase bonds decreases the bank reserves and thereby decreases the amount of money in the economy. Removing money from deposits to purchase bonds. So again, money is going from the bank vault to the Fed. That decreases the bank's reserves and thereby decreases the amount of money in the economy, decreases the amount of money that is available to borrow. During this process, the money multiplier further decreases the money supply, right? Michael's not borrowing, which means that the restaurant owner is not borrowing, which means that some other business is not borrowing. Next, we are going to discuss the reserve ratio as another tool used by the Fed. So reserve requirement, I think we've talked about this, that's the fraction of deposits that banks must keep on hand as reserves, either as currency or on deposit with the Federal Reserve. And what we're doing here is we're thinking about the Fed saying, listen, we don't want you to loan out all your money. Again, we don't want to get into a situation where lots of people want their money back and you can't do it. So we have decided that you need to keep, say, 5% of your money out. So what happens? Well, as we saw before, when we think about money supply changing, that's done by reserves changing, and it can also be affected if the reserve ratio changes. And I think we talked about this before, that 1 divided by the reserve ratio is equal to the money multiplier. So that's an inverse relationship. When the reserve ratio gets higher, the money multiplier goes down. And that makes sense, because when the reserve ratio gets higher, what that means is we need to keep more cash on hand, You need to keep more money in the vault, which means there's less available to loan out. So repeat this part. So when the 1 divided by the reserve ratio is equal to the money multiplier. So we can take our change in reserves, our money put in the vault, use the money multiplier to figure out how much money how the total amount of money created through all the lending and saving and lending and saving. And that's equal to 1 divided by the reserve ratio is equal to the money multiplier. And the relationship is that way because when we make the reserve ratio larger, that makes this fraction here smaller, so the money multiplier is smaller, which means we're not able to create as much money from increased reserves. Okay, so I'm not going to throw this on top of that. I think I have the question on the next slide. Yeah, so we'll just go through it together. Suppose a bank gets $100 in new deposits. How would a change in the reserve ratio from 5% to 10% affect the money supply created? So we take our new money deposited, multiply that by the money multiplier, that gets us the change in our total money supply. So if we have a reserve ratio of 5%, 1 divided by 5% gets us the money multiplier, which is 20. We can take that money multiplier of 20, multiply it by our $100 in new deposits. 20 times 100 is 2,000. Now, what if instead our reserve ratio is 10%? Well, with a reserve ratio of 10%, now our money multiplier goes down to 10, because 1 divided by 0.1 is 10. 10 times 100 is 1,000. So notice that when we increased the reserve ratio from 5% to 10%, what that did was it reduced the money supply from 2,000 down to 1,000. Decreasing reserve requirements is an example of expansionary monetary policy. More money leads to a lower interest rate, leads to more investment. Money supply increases either because we are using open money market operations and putting more cash in the vaults, or by adjusting the reserve requirements to allow banks to lend out more of their money. Either way, increase in the money supply leads to a decrease in the interest rate, and that leads to an increase in investment demand, right? So we started off here, interest rate decreased, investment demand, quantity of investment increases. So we move down and to the right on this curve. So notice we've increased investment, and as we've discussed, increasing investment increases aggregate demand, increases GDP. Increasing reserve requirements is an example of contractionary monetary policy. So this is taking money out of the market through open market operations or forcing banks to keep more money in the vault. Well, there's less money out there. That leads to a higher interest rate. There's not much money. Available. So if you want it, you're going to have to pay for it. This higher interest rate leads to less investment. We can show that here. Our money supply shifts to the left. That leads to higher interest rates. What happens with higher interest rates? Well, according to our investment demand curve, we're going to move up and to the left. Again, less money leads to higher interest rates, which makes us move up and to the left and leads to less investment. So the Fed uses the reserve ratio tool less frequently than it uses open market operations. So we don't typically see the Fed doing a lot of adjustments to the reserve ratio. And a couple of reasons why. The first is that sudden changes in requirements can affect bank operations, right? Banks don't want to have to deal with this uncertainty that tomorrow they might have to hold more cash in the vault and they might have to hurry up and figure out a way to acquire cash. And many banks already hold reserves in excess of what is required. So I think we saw an example of Bank of America, and they were they had many more reserves than they were required to, which means that if you were to slightly increase the amount of reserves that Bank of America needs, well, they wouldn't affect them because they were already above that point anyway. All right, so that's all we have for today. Thank you, everyone, for your showing up and for your attention. Have a great rest of your day, and I will see you back here on Wednesday.